Welcome to Lesson 7 on green bonds. We will explore how debt capital markets and green finance instruments pave the way for a sustainable economy. Sustainable bonds are a major part of this market, with issuance exceeding $1.1 trillion in 2025. By the end of this unit, you will be able to describe the debt products available in green finance, including bonds and asset-backed securities. We will also describe the features of green bonds, explain key frameworks and standards, and describe how securitization works for small green loans. Debt capital markets are the financial backbone of sustainable investment. Bonds fall into two categories: organization guaranteed, backed by the issuer's balance sheet, and asset-backed securities, tied directly to specified assets. Key bond features include issuer risk, currency risk, coupon, and maturity. Debt is ideal for green infrastructure because 70% of renewable energy projects rely on debt financing. These projects have high upfront costs but predictable returns, making them suitable for long-term debt. This is a crucial shift, as the low-carbon transition requires immense capital beyond current bank and utility capacity. A green bond is a fixed-income instrument that raises capital in the debt market. The key difference is that the issuer publicly commits to using the proceeds exclusively for green projects or activities with environmental benefits. Green bonds align financing with sustainability objectives for the economy, environment, and society. The four aspects differentiating green bonds include the use of proceeds for projects with positive environmental outcomes, external review by qualified reviewers, disclosure and management of proceeds through tracking and auditing, and reporting on the environmental impact annually. There are different types of green bonds with varying risk profiles. Use of proceeds bonds are the most common, backed by the issuer's balance sheet. Green project bonds are backed only by project assets, leading to higher risk and return. Green revenue bonds are backed by pledged revenue streams, such as transit revenues. The green bond market has grown from a niche innovation to a mainstream asset class. Estimated global cumulative issuance reached nearly $7 trillion in 2025. Over 628 issuers and 180 countries now participate, with new markets continually opening. Green Sukuk are Sharia-compliant green bonds that are a natural fit for Islamic finance. Unlike conventional bonds, Sukuk must be asset-backed and prohibit interest. They emphasize environmental stewardship and public benefit. Key market milestones include the world's first green sukuk in 2017 and formalization of standards in 2020. Asset-backed securities, or ABS, unlock capital for small green projects. Securitization involves bundling revenues from a portfolio of small green loans into a structured security. This process diversifies risk and converts illiquid loans into tradable instruments, benefiting both borrowers and institutional investors. Policymakers can support green ABS markets using two mechanisms. Option 1 is the purchase of first-loss debt tranches by the government, which de-risks the investment for private investors and helps build market expertise. Option 2 is using a credit quote wrapper or monoline insurance, which improves bond ratings but does not build market expertise in green asset cash flows.